Hello, this is John Cavalli, and this is your March capital market, financial planning, and economic review with an emphasis on tax planning. It is tax season. I'm filming this on the last day of March, and so taxes have been very, very prevalent. And I appreciate in advance everyone watching this. I'm donning a little bit of summer gear to bring in the summer fun, hopefully. So we will cut to the video, and I will get right along. But I wanted to thank you for joining us. All right, so here is our March 2015 financial planning tax tip, capital market, and economic review video. We have been focusing a lot on taxes just because we're front and center of taxes. Donald and I actually spent several hours reviewing tax items this morning, and so it's definitely front and center, but I'll promise next month we won't bombard you with one. This actually came up originally on the Sirius radio interview that I co-hosted, and it's really interesting. The main thing I would like for you to gather from this is that if you are in a position to do a Roth or a tax-deductible IRA or 401k, something tax-deductible or a Roth, generally, statistically, as odd as it may sound, a Roth is not your best bet because taxes at retirement are lower than taxes during your earnings years. So that's the main point that I wanted to come. We've had a few questions over the past couple of weeks about to Roth or not to Roth, and I did do a blog post a week or so ago, but I wanted to re-review this, so that's your tip. And statistically, if tax rates stay exactly the same, then you will have no difference between a deductible IRA or a Roth, but generally tax rates go down. All right, I wanted to throw this in. This is interesting. I'm going to talk some more about this. It won't quite fit, but here's basically what's going on so far this first quarter in the S&P 500. Nothing. Why would that happen? Well, earnings are expected to be flat and even down, predominantly for the energy sector. We've crowed about investing overseas, and we talked about leaning that direction. We never go all in anywhere, but we talked about leaning that direction in the fall. And look at this. Boy, were we right. This is the DAX, which is the essentially one of the major indexes overseas. Up 20+%. Man, what a great call, right, John? Well, forget this but. At the same time, here's the United States dollar. And essentially what this did is the dollar this is not the dollar, I'm sorry, this is the DAX against the United States dollar. And it's a good representation of the dollar has gotten so strong that it's pretty much mitigated all of these returns. Meaning that the true return is very flat. It's up a little bit, but very flat. The good news is this stuff works itself out over time. This is a function, and I've mentioned this as well in the past couple of posts. This is a function of what the lower interest rate environment has done, and the markets are trying to make the expectation that that I almost said Bernanke, that Janet Yellen and crew are about to raise rates, and so the dollar's getting stronger. This is one of the unintended consequences, you might say, of quantitative easing. So here, can't leave with all mellow news. If you're going to go overseas, now is the time to do it because the dollar is really, really strong, obviously, right here. And all those goodies and things, food, travel, things that you may buy, the dollar will convert and be a good, strong point for us. So that's it. I want to thank you. I appreciate very much. We'll see you next month, and I'd like for you to certainly go to our YouTube channel, which will show this post. Thank you very much.